What is up, people? Welcome back. So this week, so many exciting things happened on the financial markets, including Jay Powell giving speeches twice in a day, which is really unusual, among other things, which should send gold to the moon. But if you look at the gold market, it's wiped out 4% just alone this week, and many people wondering that in this economic climate, how the hell gold is getting hammered. Inflation is 4 decades high, global supply chain is getting destroyed, there is a war going on in Ukraine, and we are on the brink of a global food crisis. All of these factors alone are very bullish for gold, but bringing them together should blow up the whole freaking market. And yet this week gold wiped out 4% of the total market value, and people are wondering that what the hell is actually happening on the gold market, because everything points into the direction that gold should go up. And nothing to worry, because I'm here to explain what I discovered on the gold market. I'm going to show you every single detail on the gold USD spot market that you need to understand and keep your eye on it in the coming weeks and months, because if you're ready and if you spot the opportunity, this can bring you huge profit potential. So the first place where we always start the analysis is the economic calendar and understanding the fundamental factors that can move the markets. So 21st of April, Thursday, just the past week, you can see that Jay Powell gave speech twice a day. Now it's really unusual because our man Big P doesn't really go out to the press twice a week, not alone in a single day, which already brings us to the question, what the hell is happening and why is he giving interview to the press? Now, the big reason why Jay Powell gave speeches twice in a day is to give some forward guidance to the market, because this is how the central bank of any country works. They stand out and transparently manipulating the market, trying to calm the nerves of investors in order to create a stable financial system. And we know exactly that in the US, the current inflation rate is above 8%, which is 4 times the Fed target rate. And of course, they have to do something about inflation. They can do 2 things about inflation. The first thing, they can raise interest rate, which they already did by 25 basis points, but you can see it's a long way. So the other thing that the Fed can do is to reduce that massive balance sheet they built up over the years since the financial crisis. On the chart, you can see that when the financial crisis hit the market and we had the credit crunch, the Fed started the QE, or quantitative easing, or large asset purchases. It has many names, but the single reason was to pump money into the economy, so the Fed tried to spend their way out from the recession. And the Fed balance sheet includes many things such as mortgage-backed securities, treasuries, and of course on the liabilities side we have the US dollars in circulation and all the currency reserves which is deposited by the retail banks at the Fed. And you can see that this is a massive balance sheet which they need to reuse, because all the dollars that they pumped into the system caused this massive inflation that the low-income households are really suffering in the US economy. The most important takeaway of the 2 speeches or information that gave Jay Powell to the market is that how much and when they're going to reduce the balance sheet. And currently they agree that the Fed should shed $95 billion of assets a month from the central bank's balance sheet in order to tackle inflation. Now this number is huge, because last time when they started reducing the balance sheet, you can see that it was back in 2015. At that time it was only $10 billion a month. So you can see that there's a massive difference, that currently they're planning to do $95 billion, but the last time it was only $10 billion. So they're going to start it in a couple of months. So we need to look into how the last balance sheet unwinding affected the gold USD spot market. And we're also going to look into how the interest rate decisions affected the gold market. So not 1 but 2 things. I'm going to show you how to trade gold in the current monetary policy environment. Now these charts and the underlying data can be accessed on the Fed website. This is free and public. The ticker is WALCL. This is the whole balance sheet of the Fed that they're planning to reduce in the coming 1 or 2 months, starting the asset reduction by $95 billion a month. Now all we have to do is combine 2 charts. The first is the Fed balance sheet that you can see on the screen. The second one is the gold USD spot market that you know very well. So once we have it, then we can see that how gold market reacted to the last time when the Fed started or had the intention to reduce some of this massive spending which occurred since the 2009 financial crisis. And for that we have to go back all the way to 2018. On the chart you can see I already did the footwork for you. So WACL is already already added to the gold spot market. On the left hand side you can see the percentage change of the Fed balance sheet. On the right hand side you can see the percentage change for gold. Now it's important to understand that the two data series can be only combined when they normalized in one single denomination, which is percentage term, because gold is just massaging 1930 at the moment, but if you look at the balance sheet, it's currently $9 trillion. So because of these numbers, it's difficult to add the charts together, but if we convert the data into percentage, then it's much easier to handle it and much easier to chart it and visualize it. If you go back to the original chart, you can see that the attempt to reduce the balance sheet was back in April-May 2018, so it was exactly 4 years ago. So we have to find 2018 April, and it was going all the way to 2019 September. I think that was around the time when COVID really started back in Asia. So we're going to mark this area. You can see that this is where the balance sheet reduction started and this is where it ended. And during this period, gold skyrocketed almost 20%. Now, if you move it down to the bottom, you can see that this increase was actually 34%. And the reason why we're calculating the price increase from this level and not from the beginning, because there was a difference between January to April and April onwards on the reduction of balance sheet back in 2018. The Fed doubled the balance sheet reduction amount every single month beginning of April, May 2018. But what we're really interested about, how gold reacted before. So you can see on the chart that there is a direct correlation between the size of the balance sheet and what the Fed was trying to do with it and gold price, because gold is heavily driven by monetary policy. But if it wasn't enough, let me show you another thing which is going to be bullish for gold. If you look at the last time when the Fed started increasing the interest rate was back in 2015 December onwards all the way to 2020 March, you can see that the first interest rate increase was back in 2015 December. And as soon as the Fed announced the rate hike of 25 basis points, gold was unstoppable and increased thousands of pips in the coming years, almost 100% increase from 2015 all the way to 2020. But the most important thing is what happened before the Fed started increasing interest rate and reducing the balance sheet. You can see that every single time before the Fed was trying to increase interest rate or reduce the balance sheet, gold reacted the same way. It was going down. So it was the time when the Fed or Fed members were just talking about the possibility that we want to raise interest rate and we want to decrease the massive balance sheet that we hoarded over the years. And this is what manipulation looks like on the gold market. When they're talking the talk and not walking it, you can see gold price was dropping, but as soon as they took action, gold started to fly, and this time it isn't different. You can see that the current price level, this was back in early March when the Fed started to raise interest rate, and it resulted in a massive almost 2000 pips increase in gold price. But the problem with this was that we didn't have any information about by how much they're going to reduce the balance sheet. And now that we had this information, look how gold is reacting. It wiped out 4% of the market value within days, despite the huge inflation that's going on all around the world, the war in Ukraine, the supply chain issues, and the list can go on forever. Despite all of these bullish variables, gold is dropping, and the reason for this is because the Fed hasn't started reducing the balance sheet. But I guarantee that as soon as they start reducing this $9 trillion balance sheet, gold is going to the moon, because this is how it reacted the last time. This is how it reacted back in 2015, back in 2018. Before the Fed actually did anything, gold was going down, and as soon as they took action and found their balls to increase interest rate and reduce the balance sheet, gold was flying to the moon. You can see that since 2018 on 2015, gold doubled its price, 100% increase, and we're talking about thousands and tens of thousands of pips and hundreds of thousands of points that the gold price was moving up. I know you want to find some juicy entries, and let's see if we can find a sniper entry for you next week. You ready? It's coming. We are going to start right on the 4-hour time frame. You do not go to the daily or weekly because we have every single information on the 4-hour chart. First thing we want to observe is this wedge, which has important information to us. Gold broke out from this wedge with an impulse move, and we all know that every impulse move is followed by a retracement. So if you use the Fibonacci retracement tool from the very low of this wedge, maybe just average the candle wicks, but try to cut as many wicks as possible, pull it from swing low to swing high, you can see that gold price is currently massaging the 61.80 price level. But we have another lower entry, which is a potential entry, and gold usually reacts way much better to 78.6. I don't know why, but I found this over the years that gold is reacting way better to the 78.60 than the 61.80, but it doesn't mean that this won't be a good entry. We don't know yet, so this is why we are going to go down into a lower time frame. But for now, we have two potential entry points, 61.80 and the 78.60, which we are going to mark and monitor for the coming days. And the second thing we want to do is set alert for these price levels. Now, this price level was already penetrated, so what we're going to do is, if price comes back to 1930, which has an important relevance if you look back historically, what happened around this price level, this was the average for this massive consolidation which took place all the way from 2020 March, took place for weeks. You can see that this was the average or true mean of this consolidation. This is why it has meaningful information. But if it comes down lower to the 78.60, which I said gold responds much better to this price level, then we're going to set another alert around 1920. So when price comes back down, we know exactly that we have to buy at this price level. Now that we have our key levels marked with an alert, so we get notification when price comes back down, all we have to do is go to lower time frame. Now you may ask the question, do we set a buy limit, or what do we do with this, Tomasz? Yes, you can set a buy limit, but you have to use a wider stop loss because price has the potential to bounce back from 61.80 or even come down to 78.60, because remember that the balance sheet reduction and the next interest rate increase is not going to happen in the next 1 or 2 weeks. So I think we have more downside potential, but we cannot rule out the possibility that 61.80 is going to be the sweet spot where gold price is just going to bounce up. And my best guess would be on 78.60. So for the sake of example, imagine that the next candlesticks or the price action is going to be bearish for the coming weeks and price tapping into the 78.60, and maybe it's going to move sideways for a while, spending some time at one of these price levels. It could be 61.80 or 78.60. We don't know yet. The kind of price action you want to see is something like that. First, the candles are going down, and maybe, but not 100%, price is going to go sideways when it finds this nice price level, because price action is going to be in equilibrium. Where buyers and sellers agree that yes, this is a perfect price. So that's why you see sometimes price and candles are moving sideways, because the market is in equilibrium. And this is the important part. You want to pay attention. You want to see the break of this kind of market structure. You want to see that price is breaking the previous price action. You want to see an impulse move which invalidating this sideways movement or this downward movement, whatever it is, it's on the left hand side. And if you want to see that prices and candles are going higher and higher, if it lines up with a nice Fibonacci retracement level, you can add the juicy RSI as well, which should come to a near extreme low level around 20 or 25. So if you have multiple confirmations which are pointing to the direction that yes, this is going to be the destination from where gold is going to the moon, and when everything lines up on the chart, so you have minimum 3 confirmations, that is going to tell me and you that yes, we made the right decision and gold is going to continue its way higher. So for right now, I am still bullish in gold and I'm focusing on buys. Currently, we have to endure this massive retracement which is happening on the market right now. And remember that every impulse move which happened right here is followed by a retracement which is happening now. The most important thing is that we have two entry levels, 61.80 at 1930. Remember these numbers. And the second one is at 1915. So I'm going to look for entries at 1930 and 1915. So these are the two price levels. I will be looking for entries, and if you're asking what should be the stop loss, I would say leave around $5 just to be safe. So you might ask the question, but Tomasz, are you not going to trade gold for the coming 1 or 2 weeks? And I say, yeah, if price doesn't come down to this level and if I don't see the kind of confirmations I want to see, I'm not going to trade gold, because when market isn't favorable for us, all we have to do is just move to another asset class. And if you look at my MetaTrader, you can see that we had other good trades in USD CAD and US30, which we took just a few days. On 21st of April, you can see that how beautiful was this dips, resulting in 1,600 pips, and USD CAD isn't different. We're currently up 223 pips pips, which is insane result just from one single trade. So if the market in gold isn't favorable, all you have to do is just choose another pair, what you know, and focus on quality trades. And if you need help, I do live streams every single day on YouTube. So all you have to do is sign up to the channel, allow the bell notifications, which is on the top right hand corner, so you get notified every single time when I go live, and you can take the trades with me, even though this is not financial advice. But if you want daily analysis every single day delivered to your personal Discord, and if you want morning briefings with me, which is about 30 minutes explaining the fundamentals and the technicals in the market, all you have to do is just get a membership and join the Alpha FX team. I have some good news, because this week I'm going to start the usual monthly sales, so all the prices will be reduced 40% this time, not 50%, and you have the opportunity to join one of the fastest growing trading communities. And what you get is a lifetime membership, daily analysis, daily Zooms, daily morning briefings, so the whole package. So if you want to get the discount code, make sure you join to my Telegram or Discord, link in the description below. I hope to see you very soon in the team, but until I have to say goodbye, this is the Alpha FX.